Long-term equity investments. What do you do when there is no market for the stock? For example, if there's a family business that's a corporation and is closely held, you really don't have a third-party market like the New York Stock Exchange or the NASDAQ in order to have arm's length transactions to know what your stock is worth. So, if that's the case and there is no market, you'll use the cost method if you own that stock. So let's get started. For the cost method, there's basically the entry to buy at whatever it costs you. So debit long-term investment in equity security or the name of the stock, credit cash for what you purchase. If you have dividends, the date of dividend declaration is debit dividends received, credit dividend income. Remember, dividend income occurs in the year of declaration, not when the cash is paid or received by you. And then on December 15th, the date of payment, debit cash, credit dividend receivable. Remember, dividend receivable is a current asset because you get paid pretty quick once a dividend is declared. And finally, what do you do when you sell a closely held stock or investments? You're going to debit cash for the sales price. You're going to credit long-term investment in equity security for the number of shares and the original purchase price. And you're going to plug either a debit for a loss or a credit for a gain on the sale of those securities. So let's see an example. Mystic Lakes began investing in equity securities for the first time in 2017. During 2017, the company engaged in the following transactions involving equity securities. Assume that the stock of Thayer International and Bear Enterprises is not considered marketable and is less than 20% of the voting stock outstanding. Prepare the journal entries to record these transactions. So when you see a problem like this on an exam or some other place, the key phrase here is not considered marketable. Because as soon as you see that, you go, I'm going to do the cost method, and which means I have journal entries when I buy, when I sell, when there's dividends, but there is no adjusting journal entry at the year end because I can't mark it to market because the market value is unknown. So number one, when we purchased 10,000 shares of Thayer International for $26 a share, we'll debit investment in equity securities, credit cash for those 10,000 shares times $26 or $260,000. In number two, when we purchased 25,000 shares of Bear Enterprises for $35 a share, we do something similar. We debit investment in equity securities, 25,000 shares times $35 a share, credit cash for $875,000. When Thayer declares a $2 per share dividend to be paid at a later date, that's the date of declaration, so I'm going to debit dividends receivable for 10,000 shares times $2 a share, credit dividend income. Continuing on in number four, when we sell 4,500 shares of Bear Enterprises for $30 a share, we'll debit cash for the 4,500 shares times the sale price of $30 a share, or $135,000. We'll credit investment in equity securities for the cost, 4,500 shares times the $35 purchase price, $157,500, and we see that we need a debit to make that entry balance, which means we have a loss on the sale of Bear Enterprises of $22,500, the difference. And number 5, when we sell 8,000 shares of Thayer International for $32 a share, we'll debit cash for the sales price, 8,000 shares times 32, or $256,000. We'll credit investment in equity securities for the 8,000 shares at cost, which was $26, or $208,000. We see that we need a credit to make that balance, so we'll credit gain on disposal or gain on sale of Thayer International for the difference, or $48,000.